Well, after what seemed to be months of absolute chaos, we finally saw a day today in markets that was relatively quiet, pretty range bound in the S&P 500. I think we finished down right about 0.25% as the close finally rang in. So the question now is the chaos over, or should we expect more right around the corner? One of the things we're going to be touching on in tonight's update is that exact question. I also want to kind of broaden the overall perspective of that idea, just in terms of now that the dust has settled from that massive sell-off that we saw at the beginning of April and just kind of all the chaos, the tariff chaos that we've seen to this point. What is the market telling us, and how should we be viewing the broader macroeconomic implication of everything, not only from what the market is telling us, but also what the data is showing us? Where are we at right at this point? Let's figure out where we're at, where we're headed, what the market's telling us, what the data is telling us. That's what I want this update to be about. So before we get into the nitty-gritty of the details, if you are new here, hit subscribe, turn that notification bell on so you won't miss any updates going forward. If you find this video particularly helpful, give me a thumbs up on the way out. I'd much appreciate it. All right, what I have up on screen, here's going to be my argument tonight, is that we are in a difficult spot to actually know what the hell is driving the moves that we're seeing. It's really my argument here is, up until this point, my thesis, what our models were showing us, what I was anticipating was a massive credit boom as we headed into, say, 2026, 2027, that we would start to see equities really take off, that we would start to see us get into the part of the business cycle that really we haven't seen in quite some time. We would possibly even see stocks, value stocks, the sort of equities that have been battered over the last 15 years relative to, say, just the S&P, that they would start to outperform. Things like the rest of the world would start to outperform, and that we would see eventually inflation tick up, maybe closer to 2027 or the end of 2025 into 2026. We would see that sort of move from kind of a moderate growth, low inflation, to a more accelerating growth, higher inflation. Then Trump came in, tariffs came in, and we saw a collapse in equities. We've seen a collapse in bonds more recently. We've seen a collapse in the dollar. We've seen a firing higher of gold. A lot of chaos has ensued. And so now the question is, okay, what is the market telling us? What is the data showing us? And what do we make of all this after, again, the dust is quote unquote settled? And where should we be looking into the future? And my argument's going to be is, look, I'm not 100% sure what we're seeing and what the main driving force is from a macro perspective of what we've seen with the collapse and then kind of rebound of stocks, the collapse in the dollar, the somewhat more sudden recent collapse in bond prices. But what I will say is, I think regardless of what the main underlying driver is, so I'm going to make two arguments for what it could be. I think there is a way to kind of price or position yourself for whatever outcome or whatever underlying driver it turns out to actually be. So I'm going to give kind of both arguments here, and almost debate with myself, if you will, as to kind of the validity of both sides of kind of the argument for what's making the drive. So where I want to start is just with what's on the screen right now, and that is that once Trump took office, and since Trump took office and the tariff reality became a reality, we've seen an outperformance of the rest of the world relative to the U.S. Now, what I have on screen is the S&P versus Europe, but this is kind of across the board. The rest of the world has just outperformed the U.S. at a scale not seen in quite some time. You can make the case that the sell that we saw in 2022, that was the case. Slightly different, though, that just all assets were selling very hard at that point. But you really have to go back to pre-Great Financial Crisis timeframe to see any sort of sustained outperformance of the rest of the world relative to the U.S. And again, my argument before Trump took office is that's probably what we were about to see anyway, and we're starting to see the beginning part of that as well. The next thing that I'm going to bring up is I'm going to bring up the dollar index, which again has been faltering quite a lot as of late. Now with this, again, you have to go back to the pre-Great Financial Crisis period to see a sustained drop-off, strong sustained drop-off of the dollar relative to the rest of the world. What's also interesting as well is in more recent times, again, post-Great Financial Crisis, it has been the dropping of the dollar that has signified a very strong market move. Of course, this time we saw a drop in the dollar and in U.S. equity prices, a correlation that rarely has popped up over the last 15 years. And of course, that correlation with the dollar pushing higher, signifying debt stress signifying shortage of dollars, that sort of thing, coinciding with more choppy markets. That correlation really breaks down again prior to the great financial crisis. So again, just an entirely different regime. So we're talking about some correlations that had remained in place for the last 15 years, now looking like they did, potentially signifying a move back prior to a regime that we haven't seen in, say, 15 some odd years. So you have that as well to kind of add to this argument. Jumping back to this now, I'm going to hide the dollar. We also are seeing rates continuing to push ever so slightly higher. And again, it's been quite some time. Of course, we saw the jump up in rates when the Fed set rates higher during the inflation move. But again, if you look back to the pre-Great Financial Crisis, where that kind of last time frame where the rest of the world was really outperforming the U.S., that was another time frame when you saw rates consistently pushing higher. And of course, the reason for that is as we had our massive kind of credit bubble during that time frame that usually precedes some sort of inflation, and growth in inflation will push the Fed to want to raise rates. So rates are going to get ahead of the Fed and they will push higher. And so we're continuing to see that. So my argument here, at least kind of the picture that I'm trying to paint at this point, is that when you look at least what the market is pricing in, you could easily look at it and say, God, the market is pricing in maybe a switch to a kind of a quadrant of accelerating growth and accelerating inflation in a way that we haven't seen in quite some time. And that is exactly what our models, and if you go back, say, 6 months or so before Trump ever took office and we went through the chaos that we've seen, that is exactly what we were anticipating as well. However, you could easily make the argument that everything we're seeing is also just a complete breakdown of the kind of world regime that we've seen over the last 15 years, in the sense that how the world has operated after the great financial crisis is they have found it, the rest of the world has wanted to export to the U.S. so the U.S. could import that and then export its dollars back out. And that was kind of the agreement that the post-great financial crisis world was going to have, that the U.S. would consume, the rest of the world would get to manufacture. We'd have 0% interest rates and everything would be hunky-dory. And of course, Trump came in and has completely changed that. And one way you could view and kind of get the exact same outcome that you're getting, that you could view everything, is that the rest of the world is just saying, look, we're no longer going to position ourselves to be advantageous exporters, that we don't care that the U.S. now doesn't want to import our goods. We're not going to buy U.S. assets. We're not going to try and support or try and kill our currency relative to the dollar to encourage imports into the U.S. That we're going to come up with some sort of different regime. And if that were to be the case, you'd end up getting something very, very similar play out as we just saw, right? You'd see the dollar collapse. You'd see the potential for rates to push higher as U.S. assets get sold off. You get equities pushing lower. So a very similar look to just a major change in the underlying kind of global order. In scenario one, that's going to be the scenario where we expect high growth with a growing inflationary push. What we would expect in scenario one is for the rest of the world to continue to outperform the U.S., but we wouldn't necessarily expect a major change in the underlying regime. But still, in that scenario, one way or another, in that first scenario, we're looking to see assets finally outperform that haven't outperformed in the past 15 years. And ultimately, we would eventually revert back to the mean, so to speak, or back to the prior regime once we finally kind of hit a recession, say in 2026, 2027. Under option number two, this is kind of the interesting part about, at least in terms of positioning, thinking through how you would position in this scenario. You're going to expect the exact same outcome. The rest of the world of outperformance, underperformance in the U.S., and the sort of assets that have underperformed for the last year should start to outperform in the second scenario as well. However, under the second scenario, it gets a lot worse for the U.S. and maybe a lot worse globally once you finally get that recession, because where the U.S. has been the backstop, you're not going to immediately see that in what that backstop is to support the global kind of macro foundation. We're not going to find out until it finally happens. But after it, without a doubt, the U.S. is not going to be the kind of primary leader of that post reconstruction period of whatever next crisis we have, because America has essentially said we just don't want to do that anymore. We don't want to be the importer of the rest of the world. We want to now, be the exporter, right? That is essentially what the administration is trying to plan forward. And maybe we don't end up seeing a recession in the next 4 years and a new administration can come in, but a lot of damage is being done. So my just in terms of damage to the current order overall. So, my current thought here is, regardless of what's the actual driver, the outcome, at least in terms of kind of, thinking about positioning as a whole, is very similar, right? And I've been, going back even a couple months, put out a video saying, hey, look, it looks like we're just trying to copy Europe. It wouldn't surprise me if we see now Europe, which has to copy the US to spend because of existential crisis of, potentially being invaded. Now that Europe is going to copy the US, we could start to see Europe and the rest of the world really outpace the US. And, for my vantage point, that is where I am looking to position more and more aggressively, just simply because the U.S. has essentially just said, hey, we don't want to be the leader of the world anymore. We want someone else to take that. And obviously that is what an election can bring, and it is brought. And so, that is where at least I see things headed. And again, what is the main driver? I don't think we're going to know if it is just the natural business cycle or if it is more of a rest of the world just kind of saying, yep, we're just done trying to position ourselves to be advantageous exporters to the U.S. and we're going to figure it out as it goes along, or is it just a business cycle scenario that will play out that we had mentioned? So that's how I'm seeing things as it stands right now, kind of where we're headed into the future. As always, if you like this sort of analysis and research, head on over to appliedmmt.com. Sign up over there if you're an active trader, active investor. As always, good trading, everyone, and we will talk to you next time. Bye-bye.